Welcome back to my channel, Balance Sheets Matter. Today we're going to be looking at Target and do a stock analysis on Target Corp. We're going to see if Target went woke and is going to go broke, or if right now they may be a good deal to buy. But before we get into the stock analysis, make sure to subscribe to my channel, Balance Sheets Matter. I do individual stock analysis videos, so if you want good ideas of stocks to buy and potentially other stocks to avoid that might be value traps, make sure to subscribe to my channel. I do appreciate the 100 plus subscribers I've got this September. I know I haven't been posting as regularly this last week. I've been very busy with work, but I do continue and intend to continue posting more videos in the future. So let's get into the stock analysis now. So let's look at some of these, first of all, just overall high level metrics here. Basically with Target, like to always take a look at the little guru focus value band, which sometimes works for stable stocks like Target. And we can see it is showing they potentially could be extremely undervalued right now. They also have a current PE of about 15 with a forward PE of 15.45. They also have, for those dividend investors, a nice dividend yield of almost 4% with a relatively good payout ratio of only 0.59 and a great dividend growth rate of 15.1%. So if you are a dividend investor, this is what we would call a nice dividend growth stock, but we're going to look into the financials and see if this is likely to continue. So let's dive into the 30-year financials here, and you can basically see long-term revenue trend is up, but they do have these like flat periods. There was this like longer flat period from about 2013 to about 2019, and it maybe looks like they're going in a flat period now. But regardless of that, basically their 10-year revenue growth trend has been averaging 8.1% per year, with EPS averaging about 8.3%. So let's dive into the financials now. First thing I like to just take a look at, which does apply to a company like Target, is we look at the return on invested capital over the weighted average cost of capital. And Target has a fair return on invested capital, typically above 10%, and that's even what they're at right now. And the weighted average cost of capital is lower, although it is a little bit higher right now, which may actually just be due to their stock price being quite relatively low. So let's take a look at the income statement. As we already looked at the revenue trend, it does go up over time, but they basically do get these little flat periods where revenue may decrease even a year before you get the increase in the future. And basically gross margins, well, back in 2008, it's a little bit higher, but it kind of more was stabilizing around this 28, 29%, 30%. But in the last few years, basically mainly in 2022 and their year ending in 2023, basically their gross margin did go into under 25, but it is starting to increase again. You can see over the last 12 months, it is 26, but in the last quarter, it's 28. So it does look like this gross margin is reverting back to what it previously was. But the problem is basically the revenue is down. And this is in a little bit of contrast to Walmart. So because Walmart is kind of one of their big competitors, I just kind of want to quickly give you an idea of what Walmart is looking on these similar metrics. So basically you can see Walmart here, over the same period of time, they've actually increased their sales more, but you can see the Walmart's gross margin has historically been quite a few percentage points lower, where Target was more around the 29% mark. Walmart has historically around 24 to 25. So there may be, because of economic headwinds or other reasons, that may mean a lower gross margin for Target in the future to more match Walmart, but it also may just basically be because of the current inflation problems and economic things. People are shopping at Walmart because it is a little bit cheaper than Target. But if the economy gets better in the future, we could see shoppers start shopping at Target again. So let's pop back into Target financials here. So basically from the revenue trend and decrease in revenue they have had and the gross margin hit, we can't really say this is because they went woke and went broke. This might just be from the same overall macroeconomic inflationary factors that's been affecting a lot of companies right now and their competition in Walmart when the consumer is trying to get their dollar to basically go further. We look at the selling and general admin. Overall, this has been net increasing over the time, and this is one of the headwinds, is when you start getting your revenue stalling a little bit and you still have that selling and general admin increasing on you, that does affect your operating margin and it gets lower. And typically before they had around more to this 6 to 7% operating margin. And right now, in the last quarter at least, they're more around 5%. So this is a little bit lower. It's hard to say if this is going to be the case going forward in the future, or they're going to be able to recover this when the economy gets good in the future. So this is something we're really going to have to watch on Target, if this is a trend going forward or they start reverting out of this, which we're going to be able to see on a quarter-to-quarter basis. Next, I like to basically look at the interest expense. Right now, their interest expense is about 540 million in the last year, over operating income of 4.7 billion, even though in the other years it was higher, so maybe this in the short term is a little bit lower. This is around that 1 to 10 ratio, which I feel is pretty fair, a pretty healthy place, although it isn't one of those super good balance sheets. But if we compare this to the past, there has been other times when Target did have over $1 billion and a lot higher interest expense. So that does mean they have been getting lower interest debt or paying down their debt, which is a good sign. So this is a good overall stable plus for Target. Next, basically, we can see the net income, overall net going up, although there was kind of a little bit of a decrease, but this is this kind of more be the revert to the norm when there was all this stimulus in 2021. They made higher margins and made a lot more money, and now they're basically the stock's crashing down as those margins are maybe reverting back to normal, and they're suffering a little bit from the economic headwinds. But if they can kind of revert back to this longer trend, because if you look at it before 2021 and 2022 there, they only had 3.2 billion in net income, and right now they're at 3.3. So this is still an improvement once we kind of get rid of those other outliers that happened in the last few years. And then basically we can see, even though despite of this, the EPS generally is increasing year over year, which is a very good sign. Again, other than those last couple of years, which were kind of more anomalies in my opinion. And this is largely due to the fact that they do buy back shares consistently, returning value to shareholders. So, I really like when companies do pay a dividend and they do buy back shares, because this is a way to basically pay back the dividend, get some of that capital into shareholders' hands. And even if you aren't growing a lot because you're becoming a more mature company, you're able to grow that EPS growth and actually grow that dividend yield for the investor as well. So now let's take a look at their balance sheet. First thing we look at, basically current assets is 16 billion right now, and their current liabilities is 19 billion. So this is not a great current ratio. It's a little bit under 1, so that would typically not be good. If they were a smaller company, it would be concerning. But if you look historically, their current ratio has actually always been a little bit bad, with basically a lot of the time their current liabilities are higher than their current assets. So let's look at their total assets and their total liabilities to see if this tells us a little bit more. And we can see right now their total assets are 53 billion with no goodwill or intangible assets right now. So this is all real tangible assets they basically have, but we will have to see if this is a fair thing based on depreciation. And the total liabilities is only 41 billion. And that leaves us a real tangible basically assets of total stockholder equity of almost $12 billion. And this is actually relatively quite a lot for a stock like Target, which only has right now, I think it's a $50 billion market cap. So let's go into the cash flow statement. So as I was saying, to get an idea of if these assets on their balance sheet are actually real, let's see how much they're depreciating compared to how much they're basically purchasing. So you can see the cash flow from depreciation has been, relatively stable over the years. It does slowly increase, because if we look at the store count, where it is a little bit stable, it does slowly increase over time as well. And maybe this Target is in the stage where their store count is going to have to plateau a little bit, just like something like Best Buy, or maybe even decrease in the future to get those efficiencies and basically not be throwing away money in bad store locations that are not providing to the bottom line. But we basically look, and in the last few years, their purchase of plant, property, and equipment has been a little bit on the high side. So they have been investing quite a lot in CapEx, actually above what their cash flow from depreciation is. So this might mean basically what we are seeing on the balance sheet and assets is a little bit overstated, as they are having to effectively replace plant, property, and equipment at a faster rate than they're depreciating it. So when we're saying, they have 12 billion in real tangible equity, well, in reality, they have stuff there which should be depreciated, but they haven't had to yet. So in reality, that actually may be a little bit lower. But from before this, we can see it was a little bit more on par, although the purchase of plant, property, and equipment typically has been a little bit higher for some years in the past. Some years is a little bit lower, but it's definitely a lot higher in the last few years right now. That also might be good going forward. If they're investing a lot in their stores, it actually could help increase sales and the consumer experience as well. And then we can see how they've been returning capital to shareholders, repurchasing a lot of stock every year, although you have these things when they do hit economic headwinds, and this is why one reason I don't like too many share buybacks actually is when the stock goes low and they're experiencing some problems, they stop buying back shares. But when things are going well, they're buying back a lot of shares. So as you can see, when they're in 2021, in January 2022, they put 7.3 billion in share repurchases. And we look at the stock here, this is all this time up here. So they bought back a whole bunch of stock all up here. And then what's happened in basically the last year here, they've almost bought back no stock, only 180 million compared to 7.3 billion. So now that we're down here, they're not buying back shares anymore. And this is one of the reasons I actually kind of prefer stocks either do a little bit more steady, gradual share repurchases, make them even each year, and more focus on providing that dividend, since at least that way they can, the investor can decide if they want to reinvest in the stock or keep that capital aside and wait for the stock to buy and do it at a better price, rather than effectively the company choosing to invest high for you and then non-invest when the stock is low because they can't. But then we can see the cash flow from dividends has been quite solid. They've been increasing that even every year, which is good. So that's why I do feel quite confident, and I do think it is good that they basically have this 4% dividend, because they've been increasing it every year. And as they're buying back shares as well, you're owning more of the company, so your overall dividend yield is going up as well. And overall, their cash flow, free cash flow, has been pretty good, except for in the year ending 2023. It was a little bit negative. You know, they have high capex. Other problems they had, that's when their margins were a lot lower. But overall, I don't see really any big problems with Target and their balance sheet. So let's look at their interactive chart to maybe get a little idea of the relative valuation. First, I'm going to bring up the analyst revenue with estimates. This is just kind of the average summation of them, and EPS with estimates. And basically you can see the revenue is expected to be relatively flat, a little bit decrease in the short term, but then increasing in the long term. But the EPS is expecting to start shooting up again. And this probably means analysts are expecting a combination of the two, that Target is going to be buying back shares, increasing the EPS through that, and that basically their operating margins and therefore their net margins are going to, and gross margins too, for a matter of fact, are going to revert to what they previously were in the past. And from the little trend we were seeing in the short term, the gross margins actually did seem to be starting to revert to what they were in the past as well. So this is probably to some degree a probable outcome for Target. So let's get rid of that now. And we're going to look at a few more things. One of these things, when you do have stocks that do have more stable dividend yields and can consistently pay them out and increase them over time, you can look at a relative dividend valuation. And you can see here, for example, let's just look at a little bit shorter time frame here, rather than all, we'll just look at 30 years, which is actually, let's go to 25, because it's still pretty long. And right now, Target does have a relatively high dividend yield. Their highest dividend yield basically was up here, which has 4.73, and right now they're at 4. So this is saying that, well, Target could potentially get cheaper. It wouldn't be surprising to see Targets get closer to a 5% dividend yield as the stock gets lower. And you'll kind of notice these two charts, the dividend yield and the stock chart, tend to inverse each other. And this is why it's one of these relative valuation methods we can use to see if Target might be a good price, as long as that the financials, which we've already looked at, support them being able to pay out this dividend yield. Next, we're going to look at the price to sales ratio, because this is another good metric to basically look at. And you can basically see that, let's pop this up for the 30 years here, that Target is getting pretty close to a historically low price to sales ratio. And again, there is a strong correlation with the price of the stock as well. But let's get rid of the price of the stock. You can see right now they're at a 0.47. During this period in 2017 here, they did go down to, what was the low here? 0.42. And in 2008, 2009, they went down to a 0.34. So, well, there is current short-term headwinds with Target. I know a lot of it's related to shoplifting and this and that, but the fact that their gross margins are increasing are actually telling me that's not the biggest issue out there, that the gross margins are coming back up. What we're seeing is, from a relative perspective, there is still potential downside for Target. It could get cheaper. Relatively speaking, on the longer term perspective, this could be a good value, but I still actually do expect Target to go lower. One of the things I like to look at when you compare basically to the price to sales ratios, your net margin is going to have to be consistent as well. And what do we see? Well, you know, Target's net margin is fairly consistent. They do have these off years where it does get low, and we are in that right now, but from analyst estimates and the trends we are seeing, these may start recovering back to where they were before, so that's a good sign. So let's take a look at basically the a more technical analysis here, and you can see I basically have my pitchfork trend, which I think is potentially the future trend going forward. And we still do have a little bit of downside, and with the momentum that Target does have, I do think this will go lower. There probably will be a very large support level right in this area right here. As you can see, all this previous price action and consolidation for Target. This is also where the 200-month moving average is and where the price volume profile begins. So I think that Target very well could get under $100, and that's actually where I'm very interested in starting to buy Target, because regardless, if they happen to resume this big trend, if you're buying Target under 100 and 10 years in the future, they go to 400, that's a great return. Even if they were to enter a more sideways period, just getting back to the all-time highs and over a several year period, actually, I would think is very probable. It could even happen in a shorter term, $260. So I feel buying Target under $100, that's what I'm looking at buying it at. You can make your own decisions. This is not financial advice, of course. I'm just giving you my opinions and giving you my analysis of the stock. So I hope you like my Target stock analysis. I hope it gave you a few insights. And if you did like the video, make sure to smash that like button, subscribe to my channel, and I'll see you in the next stock analysis video.